Are you ready to dive into the fascinating world of economics, investing, and precious metals? Well, get ready because today we're delving deep into the mind of an expert who's been in the financial services industry since 1975 and has developed his own groundbreaking method of technical analysis. I'm talking about none other than Michael Oliver, a renowned name in the world of finance. According to the momentum analyst Michael Oliver, a significant debt crisis is looming, and it's a reality we can't ignore any longer. The Fed's actions have set the stage for a crucial shift in the market's expectations, and the likelihood of a return to easy monetary policy is growing. For gold, that's like the bread and butter of its market. But that's not all. Silver has been feeling the pressure too, but it hasn't given in just yet. Despite the ongoing turmoil in the bond market and the warnings from figures like Jamie Dimon and Ray Dalio, gold and silver's reactions have been telling a different story. In this video, we'll delve into Michael Oliver's insights on the recent events in the bond market, the potential for a gold resurgence, and why silver might be bucking the trend. We'll also discuss how the Federal Reserve's decisions could play a pivotal role in the future performance of these precious metals. So let's jump right in. You see, the Federal Reserve, often referred to as the Fed, has been playing a pivotal role in shaping our economy through its monetary policies. But here's the kicker. Many experts, including Michael Oliver, believe that the Fed might have gone far too much. Now let me break it down for you. The Federal Reserve has been keeping interest rates low for quite some time, and they've been pumping money into the financial system like there's no tomorrow. This approach was meant to stimulate economic growth, but it has raised eyebrows lately. Experts, including Oliver, argue that the consequences of these policies are starting to sink in at the Fed headquarters. They're realizing that their actions could lead to inflation, market instability, and more. In recent times, the financial world was shaken by a significant event: the bond market collapse. This wasn't just a minor dip, it was a crash of epic proportions. Bond prices, which had been riding high, suddenly plummeted. To put this into perspective, let's take a look at some numbers. As inflation eases, the Treasury has recently declared a fresh bond rate of 4.3%, a decrease from the previous rate of 6.89% that concluded in April. On the other side, gold started its descent from a high monthly close in March and April, just below $2,000. While gold did experience a pullback, it didn't collapse like the bond market did. Traditionally, there's an inverse relationship between bond prices and gold prices. When bond prices rise, gold often experiences a dip, and vice versa. This is because investors typically flock to bonds when they seek safety during times of market uncertainty. However, during the recent bond market collapse, we witnessed an intriguing deviation from this norm. Bonds were in a free fall, while golds, though under some pressure, didn't experience the same level of turbulence. Gold's divergence from the expected pattern during the bond market turmoil hints at something significant. It suggests that gold may be foreseeing a substantial shift in the Federal Reserve's monetary policy trajectory. As the bond market descended into panic mode and prices plummeted, the Federal Reserve found itself in a challenging position. In previous similar situations, Fed officials openly expressed their concerns. However, this time, there was an unusual silence. This silence might be due to the Fed's reluctance to admit failure or to instill fear in the market. Michael Oliver's analysis points to a possible scenario. The Fed might be leaning towards a shift to more accommodating monetary policy, even if they can't vocalize it. This potential shift becomes a positive indicator for gold's future performance. In the world of precious metals, gold has proven its mettle as a resilient asset. While gold prices have indeed experienced a decline recently, it's important to note that this decline hasn't led to a significant collapse. Instead, gold has demonstrated an admirable ability to maintain its value even in the face of economic turbulence. Investors often turn to gold as a haven during times of uncertainty, and its steadfast performance underscores its role as a reliable store of value. Oliver suggests that gold's behavior is intricately linked to the Federal Reserve's monetary policies, particularly those related to interest rates. The recent turbulence in the bond market has prompted gold to anticipate a potential shift in the Federal Reserve's policy trajectory. This anticipation is a critical factor in understanding gold's performance. According to Michael Oliver, if gold manages to regain a foothold within the low to mid $1,900 range on a sustained basis, it could signify that the recent decline hasn't significantly altered its bullish trajectory. These price levels are pivotal, as they could mark a turning point for gold and reignite interest in it as a hedge against economic uncertainties and inflation. Michael Oliver's interview also delves into the Federal Reserve's role in controlling interest rates and its potential shift towards a more accommodative monetary policy. He highlights a critical distinction. The Federal Reserve's control is most potent in the short-term segment of the market. In contrast, the long end of the market, which encompasses bond yields, is far less within their grasp. This distinction becomes pivotal when analyzing the recent turbulence in the bond market, which has raised questions about the Federal Reserve's ability to steer the broader financial landscape. Oliver suggests that the Fed might be hesitant to raise interest rates further, especially given the current precarious state of the bond market, even if they can't openly express their concerns. Furthermore, Minneapolis Fed President Neel Kashkari's recent statement has placed a spotlight on the Federal Reserve's dilemma. Kashkari remarked that there is roughly a 50-50 chance of significant interest rate hikes being implemented to combat inflation. This statement underscores the challenging situation the Fed finds itself in. On one hand, rising inflation is a cause for concern, and the traditional tool for addressing it is to raise interest rates. However, with the current economic landscape characterized by uncertainties and disruptions, the Fed must carefully consider the consequences of such a move. Drastic interest rate hikes could potentially hamper economic recovery, making it a delicate balancing act for the Federal Reserve. The Federal Reserve's decision regarding interest rates holds significant implications for gold's future performance. Traditionally, when the Fed raises interest rates, it exerts downward pressure on gold prices, as higher interest rates can make other interest-bearing assets more attractive than non-interest-bearing gold. However, the unique circumstances of the current economic landscape, including concerns about a looming debt crisis and bond market turmoil, have introduced a degree of uncertainty. Now, let's talk about another big name in the financial world, Ray Dalio. It's fascinating to see that Ray shares Michael Oliver's concerns about a looming debt crisis. Both these experts are on the same page when it comes to this ticking time bomb in the financial world. And they're not taking it lightly. Ray Dalio, with his vast experience, knows that ignoring the signs of a debt crisis is like playing with fire, and he's closely monitoring the fiscal situation. But what makes Ray's perspective intriguing is his focus on supply and demand dynamics and how they could influence the timing of the crisis. He points out that the speed at which this crisis unfolds could be influenced by supply and demand dynamics. The exact timing hinges on how rapidly factors like government spending, monetary policies, and fiscal policies intersect with economic conditions. As these elements fluctuate, the delicate balance between supply and demand for financial stability comes into focus. The potential for a sudden shift in this balance could hasten the crisis, catching many off guard. Oliver's interview also shows that the silver market has been navigating some challenging waters recently, and it's crucial to understand the factors exerting pressure on silver prices. Several significant elements come into play here. First, the surge in treasury yields has been a major factor. As expectations of higher interest rates have grown, it has had a dampening effect on silver prices. Additionally, the relative strength of the US dollar is putting downward pressure on silver. A stronger dollar makes silver more expensive for foreign investors, impacting demand. Moreover, the Federal Reserve's stance on interest rates is playing a pivotal role. The Fed's inclination to keep interest rates elevated has fueled concerns about a prolonged downturn in silver's value. However, Michael Oliver in his analysis offers a unique perspective that challenges the prevailing sentiment in the silver market. Unlike the common notion of a long-term downward trajectory, Oliver suggests that silver is in fact moving within a sideways pattern. This pattern is marked by intermittent downward swings, but it implies a more positive outlook for silver. For those actively monitoring the silver market, there are specific price levels that Michael Oliver has identified as potential indicators of a positive turn. Despite the pressures, these levels present potential turning points to watch for. Oliver points out that a rebound to approximately $23.50 on a weekly closing basis could signify a positive shift for silver. Furthermore, surpassing the $24.50 mark within the next quarter could indicate a more substantial breakout from the current sideways pattern. These price levels serve as critical benchmarks for investors who wish to gauge silver's future performance and make well-informed decisions. If you enjoyed this video guys, make sure to subscribe to the channel, like the video and watch this one as well.